After increasing its policy rate by more than 5% in just over a year, the Federal Reserve is still struggling to tame inflation as the U.S. labor market continues to run hot. At the same time, high interest rates that have yet to be fully felt by the economy and a pullback by banks on credit suggests a higher probability of economic disappointment. We think the federal funds rate will plateau as the Fed walks the tightrope between price stability and financial stability. As a result, we are neutral toward risk-taking in our portfolios. Let's take a closer look. Market expectations for where the federal funds rate will be in January of 2024 have fallen dramatically in the wake of banking system issues. Through futures trading, investors are pricing in a roughly 1% lower federal funds rate by January. To us, this appears either overly optimistic on inflation cooling or overly pessimistic that the Fed will have to respond to a significant dislocation in the economy or financial markets. We expect moderating but still stubbornly elevated inflation to put the Fed on hold with respect to rates through the balance of the year. We expect the accumulation of economic headwinds from central bank tightening and some pullback in the extension of credit from banks to lead developed market economies toward stall speed. Still, we are encouraged that volatility has receded as systemic spillover from banking system issues has failed to materialize. Recession risk appears to have been pushed out, however, as continued labor market strength and reasonably durable corporate profits support the near-term outlook. First quarter earnings came in better than expected, and profit outlooks that seem to support current forward estimates have contributed to flattish markets over the past month despite the stubbornly high inflation backdrop. The tactical allocations in our global policy model, which guide the portfolios we manage, maintain a neutral position to risk overall. We are overweight high-yield bonds, natural resources, and modestly to cash. We are underweight U.S. and emerging market equities, as well as investment-grade credit. Equity market valuations that are above long-term fair value amidst softening economic conditions suggest limited upside in the base case, while avoidance of significant recession should be supportive of high-yield returns.